Today, we're going to explore how to master grants, categorization, and stewardship. Note that revenue recognition is driven by categorization. If you get the categorization right at the beginning, everything else falls into place. Let's start with why this is hard. Nonprofit finance isn't just business accounting with different labels. It's a three-part stewardship system. We call this the Stewardship Triad. First, you have functional expense reporting, proving why you spent the money. Was it for administration, fundraising, or program? Second, net asset stewardship, tracking whose money it is, restricted versus unrestricted. And third, award management, treating every grant like a mini business with its own rules. When these three circles overlap, you get audit-ready financials. To make that triad work, you have to look at a transaction differently. In a for-profit business, you just record the what, like printing expense $500. But in a nonprofit, that's not enough. We need to capture 4 dimensions on every single invoice. We need the what, and that's the account number. We need the why, the function, youth mentoring, admin, or fundraising. We need the whose, the net asset class, did we use restricted funds? And finally, the how else, the specific funder tag. If you set up your software to capture these 4 tags, you can answer any questions a donor or a board member asks. Now, a common mistake is trying to cram all the detail into your chart of accounts. Please don't do this. Keep your chart of accounts lean. It should only describe the what, the natural classification like travel or supplies. Look at the pitfall on the screen. Don't create an account called Travel Ford Foundation. Instead, create a travel account and tag it with one of the available dimensions that it's for the Ford Foundation. Let the dimensions handle the complexity so your profit and loss statement stays readable. Some systems can handle this natively, though basic systems such as QuickBooks Online and Xero, etc., can be structured to support this. If you have a larger budget, there are solutions that natively support fund accounting, but it does come with an increased level of complexity. See the links below if you need to adapt a standard system for small and medium-sized operations to support your nonprofit. Now, let's talk about the money coming in. We use a decision engine to categorize revenue. Step 1 is the most critical question. Is this a contribution or an exchange? Ask yourself, does the person giving the money receive commensurate value? If yes, like tuition or a sponsorship with advertising benefits, that's an exchange. If no, they're supporting the mission without getting goods back in exchange, and that's a contribution. Be careful with government grants. They can be either, depending on whether the government is buying a service for itself or funding a public benefit. Once you know it's a contribution, we move to step 2. Is it conditional? There is a litmus test. For a grant to be conditional, it must have 2 things. 1, a barrier. Second, a right of return. A barrier is a measurable hurdle you have to clear, like serve 100 kids. A right of return is a rule saying that the donor gets their money back if you fail to meet the barrier. If both of these exist, it's conditional and you cannot book the revenue yet. So conditions affect the timing of when things are recorded. You have to wait until a barrier is broken before you can record revenue. Step 3 is often confused with step 2, but it's different. This is about donor restrictions. While conditions affect timing, restrictions affect classification. There are 3 main types. Firstly, purpose. Use this for the arts program, for example. Secondly, time. Use this in 2026. Thirdly, endowment. Keep this forever. If a grant is unconditional but restricted, you still recognize revenue immediately. But you put it with donor restrictions bucket. We'll cover this in an upcoming video in more detail. If we put it all together, we get this master decision tree. It's a good place to stop the video and do a screen grab. This is your roadmap. When a check or pledge arrives, follow the path. Is it an exchange? No. Is it conditional? No. Is it restricted? Let's say it's yes. Well, then it goes to contribution with donor restrictions. If, however, it's not restricted, it goes to contribution without donor restrictions. Categorization is a repeatable path. Do it once, document it, and the entries follow. Let's visualize the timing. We've got two bars here. The top bar is the unconditional grant. You recognize 100% of it immediately on day one, even if you haven't received the cash. And when we say day one, we mean as soon as you have an award letter. The bottom bar is the conditional grant. You recognize nothing on day one. You recognize revenue step by step as you meet the barriers. And a quick note on liabilities. If you get cash for a conditional grant, that is a refundable advance. If you get cash for an exchange transaction, for example, for a ticket for next year's gala, that's deferred revenue. It's important not to mix these two up. Let's look at the journal entries. We'll look at three scenarios. For scenario A, we have an unconditional restricted grant. The first entry is when you get the $50,000, you debit cash and credit contribution revenue with donor restrictions. You claim the income now. Now, a qualifier there. We said when you get the cash. Now, sometimes you get an award letter and the cash comes later. If the award letter comes early, you would book the revenue immediately and a receivable. And then when the cash comes, you clear the cash against that receivable. The second entry later is when you spend the money and meet the purpose. You make a release entry. You move the net assets from the restricted bucket to the unrestricted bucket. Now, this may seem a little odd to someone coming from the for-profit sector, but this is a core nonprofit concept. Now, moving on to scenario B. This is the classic cost reimbursement grant. If you get cash upfront, say $40,000, you don't call it revenue. You debit cash and credit refundable advance, which is a liability. Then you do the work. You spend $12,000 on allowable costs, and by doing the work, you break the barrier. Now you can recognize the revenue. You move $12,000 from the refundable advance to contribution revenue. Let's look at scenario C. This is less common. It's where you handle a multi-year pledge. If someone promises you $300,000 over 3 years, you have to record the full receivable today, assuming it's not conditional. But because money in the future is worth less than money today, you have to record a discount on pledges. This slightly reduces your revenue today. Over the next 3 years, you unwind that discount slowly, increasing revenue until the cash arrives. It's a special case, and if there are many requests to make a video on this in the comments section, we'll add that to the list. Now, we've mentioned release a few times. Let's look at it on the statement of activities. This is a unique mechanism. You'll see negative number in the with donor restrictions column and a matching positive number in the with donor restrictions column. It always nets to zero. This isn't about creating new income. It's about moving permission to spend from one column to the other. So to keep the system healthy and operational, you need a month-end checklist. And this is what it might look like. 1, check new awards against the decision tree. 2, check your conditions. Did we meet any barriers? 3, book your cost reimbursement receivables. 4, process your releases. And 5, reconcile your net assets. Now keep the decision tree handy during this process. Now we'll wrap up with the core mindset. Keep your chart of accounts lean. Use dimensions for the complexity and trust the release mechanism. Nonprofit accounting isn't just about compliance. It's about building a stewardship system that proves mathematically that you did exactly what you promised your donors you would do. If you found this helpful, there is much more detail, including full templates and workflows, available in the book, The Essential Nonprofit Accounting Guide, linked in the description below. The chart of accounts is one piece of the puzzle. Setting up and using dimensions to capture functional categories, such as administration, fundraising and program, donor, etc., are key components to the full system to support nonprofit accounting. We'll cover this in addition to how to set this up on QuickBooks Online in an upcoming video. Thank you for your time and for the work that you do.